Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the U.K.'s latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can find me on Twitter at xbordertax. On this week's episode of Cross-Border Tax Talks, we're in our D.C. studio, where I'm excited to be joined by Matt Ryan. Matt leads PwC UK's International Tax and Treasury Network based in London. Prior to that position, Matt spent 3 years in our New York City office leading the UK tax desk, advising U.S. and foreign multinational clients on base erosion and profit shifting and all sorts of European tax matters. Matt, welcome to the Cross-Border Tax Talks.
Thanks, Doug. Glad to be here.
So this has been a topic that I've been long awaiting. I think we're over 40 plus episodes into the Cross-Border Tax Talk series, and I think
it's a big topic today.
I think we've been talking about Brexit, or Brexit has been on the radar since then, and I've just been waiting for it to actually be imminent before we finally discussing it.
Well, fingers crossed.
Well, fingers crossed. We'll see what happens. But really, before we dive into Brexit, there's something that is on the minds, I think, of a lot of U.S. folks, and probably arguably not as important as Brexit, but I think it has been coined by one of the UK publications as Megxit. So before we dive into the technical matters, I will tell you that I am obsessed now with the Netflix series, The Crown. And I have studied very little about the UK monarchy. And so I think about 99% of my knowledge is based on that particular series. But without getting into any of the details of what currently is going on in the UK about Harry and Meghan and all of that stuff that's going on, I think one of the things that's been very interesting to me about watching The Crown, first of all, is just how into, and this really isn't a surprise, I think, for most of us from the U.S., how important the monarchy is to the identity of, those in the UK.
Oh, absolutely, yeah.
And then one of the things that I found very interesting about watching the Crown is that I guess there have been times throughout history, and I'm guessing that we see today, that people question, like, does a monarchy still make sense in a modern society? And one of the interesting episodes that I saw was there was a documentary that was done by the UK royals. And I think that everybody was like, there's a famous picture of all royals sitting
in front of TV.
Exactly. Yeah. Like sitting in front of the TV, and they were trying to really help with the public perception. Mm-hmm. And I think
we're just the same as you.
We're just normal people. So my one question for you before we dive into the technical stuff is, does this place the monarchy at risk? Is there going to be a populist backlash like we are seeing across the globe? And the UK is going to say enough's enough. We're not going to fund these folks, and the monarchy is done.
Excellent, Doug. So you've actually given me the most challenging question to start off.
We'll start with that.
So we'll start big. No, this isn't an existential crisis for the monarchy. As you say, there's been issues that they've had to deal with before. They're rarely out of the press, but it just really actually amazes me, as you say, the actual depth of knowledge about the royal family in the US and the focus on it. There's probably more news in the US than there actually is in the UK. Not that actually we've been short of news recently, but no, I'm comfortable that the royal family is going to be here for years to come, and it will carry on when I'm done.
Okay. Well, and with all the serious news that we read, I think it's an entertaining break for at least a lot of us in the U.S. to learn more about it and see what's going on.
Well, absolutely, as you say, we haven't heard anything about Brexit. It's all been Megxit, so it's helped. It's taken the pressure off that.
Exactly. So perfect segue. So let's move to the topic at hand, which is Brexit. Before we dive in and start talking about some of the tax implications that companies need to be thinking about, give the Cross-Border Tax Talks audience just a brief primer on how we got here, right? There was originally a referendum, I believe, that was taken, and then it's gone back and forth, and then there's an election, and a lot of us are not overly familiar with the parliamentary process. We don't need to get into the depths of that, but remind us of just how we got here.
Sure. So I think I need to go back probably into the depths of time where about 3.5 years ago, we had a referendum in the UK with a vote, straightforward vote. Do you want to stay in the EU or leave in the EU? And the public voted to leave. But then we had to go through the parliamentary process of agreeing what the UK's position was for the withdrawal agreement, and then agree that position with the EU. And when we started off, the expectation, I think, actually, with David Cameron, the Prime Minister at the time, was that the UK would vote to stay. But no, we had the shock result that the UK voted to leave. As a consequence of that, David Cameron resigned. Theresa May came in as the Prime Minister. And then the UK had the Conservative Party that Theresa May was leading had a majority, but a small majority. So she called an election with the intention of extending that majority to make negotiations easier. What actually happened was she lost the majority and then required an agreement with the DUP to get the vote she needed to put things through.
Yeah, because in your system, they have to make an alliance to be able to try to get a majority of people to be able to try to get any legislation or policy through. So she had to team up with some other party.
That's it. So she had to team up with that party. That made negotiations more challenging. We ended up with the position that we just couldn't get any deal through. Parliament was just turning around and round and round, not moving forwards at all. And so we ended up in the position with Theresa May resigning and Boris Johnson coming in as the leader. Various people defected from the Conservative Party. We ended up with a minority government. They didn't have the support. We spun round and round and round again. And so we had another election. And then Boris Johnson got voted in with a significant majority. So if you like, you could take it that the British public had spoken. We just want this all done with and we want to Brexit. And so the vote has gone through the House of Commons. It's now at the House of Lords. It's having various readings. They can make amendments. There's some amendments at the moment. They're not through the process. It might have to go back to the House of Commons. But the expectation is that by the 31st of January, the UK will have left the EU. And then they'll be in the transition period.
Yeah, and we're recording this in mid-January. It'll get published sometime later. But is it sort of the assumption, it seems like it's the conventional wisdom that it is going to happen on February 1st, although some of us that don't follow this as closely as you do, or some of us might be a little skeptical and say, well, we've heard this before. But do we really mean it this time?
Well, I think so. Okay. You've got to hesitate because the House of Lords was significantly Remain in their view, and through the process, they kept passing things back to the House of Commons, and so they gave Theresa May a significantly hard time. But as you say, the public's spoken. The Conservatives, who had a manifesto of Brexiting, have a significant majority, and so from what I've seen in terms of some of the amendments, they're just small amendments. They're not trying to vote it down. They're trying to put additional things in the withdrawal treaty. So I do expect it will come, either some of those will get withdrawn or go back to the House of Commons, but it should be through by the 31st of January.
All right, so let's assume that it goes through. And now let's turn to what are some of the tax issues? And we can think about whether it's U.S. companies, UK companies, other European and non-U.S. or UK businesses. But I thought we could start with treaties, right? And a number of treaties make reference to whether the UK is actually a part of the EU or not. But maybe we start with that. So what are some of the treaty implications that we need to be thinking about, if and when Brexit happens?
Okay, sure. And it's good to start there, actually, because that's probably the first tax impact you get. Because I mentioned there's a withdrawal agreement, and so it's a transitional period we have till 31 December 2020, where whilst we have left the EU, we still benefit from being in a customs union and all the existing agreements with the EU stay in place. But we are no longer a member of the EU or the EAA from 1 February 2020. And so what that means from a treaty perspective is, and I think this is predominantly US tax treaties, both the US tax treaty with the UK and US tax treaties with other European jurisdictions. They're looking at, do you have good ultimate ownership? And in defining that good ultimate ownership, because you were dealing with European entities, you said basically, are you owned by someone else who is in the EU or the EEA? And so now, or from 1 February, with the UK leaving the EU and the EEA, those treaties, the equivalent beneficiaries provisions in them, you won't be able to rely on anymore. And so I think it's a case of going to the IRS and looking at the competent authority process.
And so remind our listeners what that means as far as the beneficiary, because I think that the concept is that if the U.S. would make a payment directly to the U.K., the U.S.-UK treaty is going to apply. If the U.S. is making a payment to somebody else, and I think Switzerland might be an example.
Switzerland's one. Yep.
And then Switzerland makes a payment to the U.K. For purposes of determining what rate you apply and what treaty, you have to apply this beneficiary test. But explain that a little bit more.
Well, I think actually, Doug, you pretty much explained it in a nutshell there. So there's not much more to add.
Okay. And so I guess fundamentally where I was going is that you effectively causes you to look through to determine whether you're going to be able to either take advantage of that Swiss treaty or the UK treaty, depending on what the type of the payment might be.
Sure.
Anything else from a pure treaty perspective?
I think it's the need to rely on treaties going forward. So a number of European countries in making payments to the UK, if they're dividend payments, they're reliant on the parent-subsidiary directive, which is the European directive that applies 0% withholding tax on dividends without the need to look to tax treaties, or the interest and royalties directive. So again, if you're paying interest or royalties from an EU country to the UK, that should be zero under the directive. We're in the transitional period to the end of 2020, and the interest and royalties directive carries on through the transitional period, is our understanding.
And is that an agreement with both the UK and Europe? So is that part of the leave, if you will, negotiation? Because this impacts obviously a ton of multinationals, whether U.S. or foreign-based multinationals. Not uncommon to have a European holding company, for example, or there's a number of U.S. multinationals maybe acquired a UK company. That UK company owns a bunch of European subsidiaries, and then typically we wouldn't necessarily look to the UK, let's say France or those other treaties, because we'd say, well, the parent subsidiary directive applies for purpose of determining whether we have dividend withholding tax out of that. Similarly, the interest and royalties directive, like for dividends, that directive says that any interest or royalty payments between all of the EU member states are generally not subject to withholding tax. And so I'll be honest, I haven't spent a lot of time looking at the UK treaty network with Europe, right, for years, because it hasn't really mattered, right? We would say
absolutely
these are the interest royalty directives or the parent subsidiary directive. Remind us. So that you're saying will apply through 2020 is the thought?
Through 2020 is the thought. So that is the date that is set to be the end of the transitional period, but it is capable of being extended under the agreement between the UK and the EU. But as part of the UK's withdrawal agreement, the Conservative Party have mandated that it is going to be contrary to UK law to extend it past 31 December 2020.
I see.
Whether that is a kind of negotiating position, a posturing position to just push on and get the trade deal done with the EU by the end of the year, and that there would be the potential to basically come back and change the law if we really did need to extend it. But let's assume that we do leave on 31 December 2020, you can no longer benefit from the parent subsidiary directive or the interest and royalties directive, and so you're reliant on the UK treaty network. And the good news, Doug, is the UK treaty network is really extensive, and with the large majority of EU countries, you can get down to 0% under the treaty, but say for dividends, there are some notable exceptions. So Germany would levy a 5% withholding tax on dividends to the UK once the parent subsidiary directive no longer applies.
Yeah, and so that is just I think everybody's going to need to spend some time looking at the treaty network. I think the other challenge or issue that people may need to face before they're making those payments is, well, instead of the parent subsidiary, the interest royalty directive, because the treaty applies, you then need to look at how did the limitation of benefits provisions apply to make sure that you're actually within the treaty, right? Because that's fundamentally, can you talk a little bit about that? A fundamentally different test, like whether you're an EU member versus whether you qualify for the treaty.
Sure. So we have now in a number of the treaties, as a consequence of BEPS and the multilateral instrument, we have a principal purpose test in those treaties. And so you have to determine whether the principal purpose of the arrangement under which you're paying the dividend was to benefit from the treaty to eliminate the withholding tax. And to the extent it is, you don't benefit from the treaty. So it isn't as straightforward as just saying, let's look up the rate in the treaty. Excellent, it's zero. Let's move forwards. There's a requirement to do your due diligence and confirm that, yeah, we didn't push things under the UK to benefit from the treaty. I think the helpful fact you have there is when you put things under the UK, it was 0% under the various directives, and you weren't looking to avail yourself of that specific treaty. So I think that's helpful. Obviously, you need to look jurisdiction by jurisdiction as to exactly what test they're applying. And in some instances, you just don't go and look to the treaty. You need to know whether a country is applying a specific administrative procedure. Mm-hmm. So my understanding is that once we're out of the transitional period, Italy won't be applying withholding tax on payments to the UK, whereas, say, the rate under the treaty is not zero.
Right. I've heard and I've read some questions about whether, this principal purpose test that now is within the MLI, and we spent some time talking on this about that topic on cross-border tax talks, how analogous that is to the EU parent subsidiary directive. There's a general GAR type provisions, and I do like to remind people that those are fundamentally different standards, right? And the MLI and this principal purpose test is so new that it's going to be very interested to see how various jurisdictions and tax authorities try to apply those rules, because the example that you gave is a great one. Like, how can a principal purpose of lowering withholding tax be reduction of tax if you're already at zero? But then if when you chose your UK holding company, if that was one of the factors and for purposes of determining the holding company, does that mean that a principal purpose test, where a principal purpose was a lower withholding, but if you're going from 0 to 0, that seems like a more tenuous argument?
Well, absolutely. You're looking at what was your position to start. If you were owned directly by the US, which was 0 anyway, and you've moved under the UK because you wanted the benefit of a holding company, say for recycling cash, then that was your principal purpose. Right. You weren't looking to avail yourself of the 0% in the treaty because you were 0% anyway, and you had another reason for putting the company in. So I think it's that due diligence exercise and just dusting off some historical documents and saying, hey, what were the various reasons for putting the UK there, or you look at the argument as to, why is it here today?
Yeah, the other thing I want to remind our listeners is that there is some precedence for a non-EU member applying the parent subsidiary directive and the interest and royalty directive, and that's Switzerland, right? So there's already a very good example of a country that is not part of the EU that has agreed with the EU to take advantage of the parent subsidiary directive and the interest and royalty directives. And I think practitioners and taxpayers would love to see the UK continue to be able to take advantage of that, so that capital and money can move between those jurisdictions as freely as it has. But we will see.
Well, that's it. Well, one would hope it's on the list, but I'm pretty sure it's not at the top of the list given some of the security priorities at the moment. But yeah, absolutely, it would be fantastic.
You never know who's going to be listening to the cross-border tax talks, and maybe we'll be influenced. All right, so let's talk about kind of in the context, we were talking about UK as a holding company. What about Europe as a holding company of the UK? I know there are a couple of different issues with the new controlled foreign corporation rules, how the fact whether you're in or out of the EU impacts the CFC rules. And I think the other issue is participation exemption and how various European jurisdictions may view the UK for purposes of determining whether they do not pay tax on any dividends received. So I don't know which one of those you want to maybe take first.
Yeah, let's start with CFC. So a good example, I'll stick with Germany actually that I used before. Germany has a CFC rule, and if you are low taxed, and low tax is less than 25%, and so the UK at 19% is well below that threshold. Previously, Germany just gives an exemption for countries established in the EU. With the UK leaving the EU and having a tax rate less than 25%, then that's a CFC from a German perspective, and you need to determine whether you've got passive income or not and apply those German CFC rules. The other example you gave was in the context of paying dividends. So you could take Luxembourg, which has a participation exemption where you're making a payment from an EU member. Or if you meet their tax rate test and say with the UK leaving the EU, it's necessary to determine how much tax the UK would have paid under the Luxembourg rules, and so has it met that tax rate test? So you're moving from a period where you were like, yep, the UK's in the EU, don't I benefit from the exemption, to having to go through and do a kind of computational test on an annual basis if you're paying up dividends annually, and similarly for the capital gains exemption if you're disposing of the subsidiary.
Yeah, and those are local statutory rules, right? So the example that you gave in Germany, they have this general exception for this general exception for EU member companies, and then similarly with Luxembourg, it's a general exception, and so.
Yeah.
I know Switzerland that applies. We talked about the EU parentsubsidiary directive. That I think is from a tax perspective, kind of a standalone exception. We don't see Switzerland being viewed as a good European subsidiary. So I think that what that means for taxpayers is they need to think about where do they have potential tiers of entities. We spent a lot of time talking about this with respect to ATAD in general. So I think a lot of U.S. and foreign-based multinationals are looking at their various holding structures and ownership structures to determine, do we have good treaty issues now? Do we have other foreign law, non-treaty participation exemption, CFC issues? I think a number of companies already went through this process as a part of ATAD 1 and ATAD 2. And then I'm guessing that the next thing that we're going to be looking at is as BEPS 2.0 comes online, and depending what happens with the tiers or with minimum tax, right, that we've been talking about, that people are going to continue to need to look at those structures. And I actually think that one of the trends that we'll see is the flattening of legal entity structures, just because of the amount of complexities with whether it's respect to applying a treaty, whether it's with respect to participation exemption, CFC rules, if we start talking about minimum taxes, that companies are really going to be looking at flattening their structures to avoid these kind of layers of complexity.
Yeah, I mean, you got that annual compliance burden to go through to determine whether you meet the exemptions. Once you've gone through that, in a number of these tests, as we said, principal purpose tests, is a question of subjectivity. But then actually, to the extent you still need your holding company, then companies may look at that, actually, do I want to pay a dividend, or do I want to move my money by some other means that doesn't trigger a withholding tax, because it just gives me that certainty. I think I benefit from the dividend exemption, but, why take the risk? Move the money via a loan, reduce capital. You need again to look jurisdiction by jurisdiction, but yeah, absolutely. Either flatten the structure or look at moving money by other means, or, go get some clearances.
Right. It's interesting. I've heard some policymakers make the statement, well, why do they even need holding companies, right? I think the game was a lot different pre-U.S. tax reform, at least I was speaking for U.S. multinationals, where you wanted to have a holding company so that was a vehicle to be able to circulate cash around your global structure. And that was under our old system where the money or income wasn't subject to U.S. tax until the money was actually brought home. So we would need a holding company to be able to take money, let's say, from the U.K. and invest that in Germany, to go back to that example. Now, obviously, with the new U.S. system, with our participation exemption system, if you do want to call it that, or with our worldwide system of tax with the small participation exemption we have, that's really obviously not as big a priority for U.S. multinationals.
Yeah, no, that's fair. But I think you've still got, in some instances, if you've got heavily divisionalized groups and they're looking at disposing of some subsidiaries or part of their business, if it's all happily sat in one subgroup, that just makes that disposal a lot easier. Or you can take regulated groups where you'll have a holding company below which everything is regulated, and so you don't want to move a non-regulated business into the regulatory ring fence, and so that this needs still dependent on your industry to retain those holding companies.
Absolutely, and the point that you're making is, which I 100% agree with, is that oftentimes it's not tax that's driving those particular decisions, right? When we talk to our clients, that whether it's legal, regulatory,
distributable reserves.
The other example that I like to give is that, when a U.S. multinational, anybody for that matter, makes an acquisition, let's say of a UK multinational. That UK multinational is now a holding company, right?
Absolutely,
You've acquired the UK, and it's just like, well, do we still need the holding company? It's just like, well, wait a minute, like we just acquired a Target, and by definition, I guess it is a holding company now. And so, there are any number of reasons, whether it's legal, regulatory, or just kind of factual, you kind of step into a holding company.
Step into the chain. If you bought it off private equity, the debt's gone in at various levels. That's been done to provide comfort to lenders. That you're buying a UK PLC, you've done reserves planning, you want a clean holding company. Yeah, there's so many different reasons you end up with multiple tiers of holding companies in structures. But as you say, Doug, there's a reason to go through and look as to whether any of those are surplus entities. Can I increase my certainty by eliminating some of them? And you just need to go in and dig out the books and check what the answer is.
Exactly. All right, so let's move now. We've talked about really kind of payment flows, treaties, some of the CFC issues, but I think probably one of the biggest issues on people's minds are trade. And in tax, we think a lot about that as the tax geeks that we are, as the value chain analysis, right? How do income and products flow across borders? There has been, and I had the opportunity probably 10 years ago at this point to drive around Ireland. And we spent time in Dublin and drove over to Galway, and then we went up north and went to Belfast. And from spending time over there wasn't a big discrepancy between Northern Ireland and Ireland. And I know that's something that's been a lot in the news as far as
one of the key issues, that was dealt with. Yeah.
So give us a little primer on some of those, and we'll caveat that neither of us are trade experts. Right?
Thank you. Thank you for the caveat. I did need that.
But just kind of
let's take a step.
Right.
Hopefully not off the cliff and talk about some value chain issues. Well, as we said at the moment, we will have left the EU by 1 February, but we have the transitional agreement, which means that goods can still move cross-border from the UK to the EU with no tariffs. And that's going to be the position till the end of 2020.
Okay.
So to the extent a trade deal is done, the desire from both the UK and the EU is that will continue to be the position. But businesses need to plan on the basis that might not happen. And so to the extent that there is no deal on free movement of goods by the end of 2020, then you need to look at what would those WTO tariffs be? What would be the impact on the movement of goods in your value chain, the incremental costs that you're paying on moving cross-border? And in some instances, when you're manufacturing, things are going backwards and forwards across the border at various stages of production. And so you just need to determine that. And a lot of companies have been doing this already, but they shouldn't just think that because we have this extended period and there's a desire to get a trade deal done, that it absolutely will be done by the end of 2020. The Conservative Party and Boris Johnson are very keen to drive towards that deadline, but you have the EU on the other side saying that that's going to be very, very difficult. Some people have said impossible. So you're getting some mixed messages there, but I think the consistency is it's a really challenging deadline. So ensuring you know what the downsides would be to the extent that deal is not in place, and having a contingency planning to deal with it is absolutely critical. And to the extent that you don't have significant cross-border movements, well, that might be because you're buying goods, say, in the UK from a supplier who's moved those goods cross-border for you. And so you need to be checking with your suppliers whether they've been managing their value chain. Are they going to be in a position to carry on providing you goods? Do they have the various approvals to move goods cross-border post the transitional arrangement?
Yeah, I think the challenge with that, I guess, first of all, for the accountants that are listening, just to remind people, and we had Chris Desmond, we had an entire podcast where we talked about trade issues and the trade wars. We focused on the U.S. trade wars that they have, but to remind people that those customs and duties costs are generally above the line as opposed to the tax costs below the line. Yeah. And so the business people that we work with tend to be even more sensitive to those types of costs. And so that elevates the level of importance for most executives and business people as they're thinking about those issues. I think maybe the second point that I would make is that the value chain transformation, the value chain issues and trying to transform that business take a lot longer, generally speaking, to change and fix as opposed to legal entity structures. Right?
Oh, absolutely. And so fixing those issues takes time. It takes people going and having meetings in, outside the UK. And so the other key thing that companies need to be focused on is their immigration arrangements. So travel. Has everyone that works for you got a valid passport with more than 6 months left on it? Because post that transitional arrangement, like you're going to need to go through the immigration procedures to go from the UK to the EU and vice versa. And are you inputting into the existing immigration review in the UK? There are a number of things that the personnel departments, HR departments need to focus on just in terms of getting your people from A to B where they need to be to do business.
Fascinating. So is your passport have more than 6 months on it?
Yes, I checked.
All right, fantastic. So maybe what in closing, you had mentioned that that's a great point on the HR. I mean, every time I talk to you guys and and the various experts in areas, just new issues come up, and as you read, it's just like, wow, it's fascinating. And how long has the UK been in the EU? How it's 20 plus years, right? I mean,
absolutely.
I mean, my whole career. That's
I can't remember when we weren't. Right.
So exactly. So very fascinating. So what other maybe kind of last minute? What's the last words of wisdom that you mentioned talking to the HR folks? But what should companies be doing, focusing on from a tax perspective here in the short term, and really what do we need to do before the end of the calendar year?
It's just ensuring you have that Brexit checklist. So we talked about some of the withholding taxes, the CFC taxes, and so there's a corporation tax list. Ensure that you're focused on that. You've identified what the issues are and what you can do to alleviate those. And then it's going through the value chain, checking and speaking to the customs team, your customs advisor, that you've done your contingency planning for what happens if we don't have a deal. We just talked about checking in the HR department. And I think the final area that really needs focusing on for companies is legal as well, because in a number of your contracts, to the extent that you're basically referring to the UK being a member of the EU, then there's a revision needed to those contracts. If you filed patents where you would get joint EU and UK protection, are they going to come through in time, or do you need a separate UK and EU application? So there's a number of legal things to go through. So it's just make sure you have that Brexit checklist in place and you're following it and checking that you are ready for 31 December 2020.
All right, we'll see how the law shakes out. We'll make sure you come back, whether it's right before or after December 31st of this year, and see where everything shakes out. So
excellent.
Thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thanks again to Matt Ryan, PwC's International Tax Practice Leader in the UK. I'm Doug McHoney, PwC's International Tax Services Leader in the US. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.